Hello traders, welcome back to the Forex Gig where we dive deep into the tool that can help you make smarter trading decisions. And in today's video, we are going to explore the money flow index, the MFI. Now, this is a powerful indicator that can significantly enhance your day trading strategy. By understanding how to effectively use the MFI, you can better identify market trends, spot potential reversals, and make more informed decisions about when to exit and when to enter a trade. So throughout this video, we would provide a detailed explanation of the money flow index and a step-by-step guide on how to integrate it into your day trading routine. So stick around until the end to learn how you can leverage this valuable tool to improve your trading outcomes. We start by understanding what the money flow index is, and the money flow index, the MFI, is a technical indicator used in the financial markets to assess the strength of money flowing into and out of a security. It combines both price and volume data, making it a powerful tool for identifying overbought and oversold conditions, as well as potential trend reversals, calculations, and interpretations. The MFI is calculated by first determining the typical price of a security. Then it is then multiplied by the volume to obtain the raw money flow. Positive money flow are summed when the typical price increases, and negative money flows are summed when it decreases. The money flow ratio is calculated by dividing the positive money flow by the negative money flow, and the ratio is then used to derive the MFI value, which is ranging from 0 to 10. Now these are basically calculations, and the indicator has already done all those calculations for us. We just need to keep in mind some key features such as the oscillating range. The MFI moves between 0 to 100, meaning it moves between 0 to 100, with values above 80 indicating overbought conditions and values below 20 indicating oversold conditions. So once it's above 80, you know that we're in an overbought condition. Once it's below 20, we know that we are in an oversold area in the market. Now there are divergence signals, and a divergence occurs when the MFI moves in an opposite direction of price, often signaling a potential trend reversal. So let's see the trading strategy with the money flow index for day trading. The first step is to set up your chart. To set up your chart to effectively use the money flow index in day trading, you start by setting up your chart with your MFI. This is the indicator. You use the typical period, the default period of 14 period length. This is a setting and is ideal for capturing short-term fluctuations that are characteristics of day trading. Additionally, you have to consider adding a short-term moving average such as the 20 period moving average to help confirm trends and provide quick insights to market movement. So we're going to use a short-term moving average. So to change our short-term moving average to the 20 period moving average to help us better understand how our MFI day trading strategy works. The second step will be to identify your trading opportunities. In the day trading, the speed and precision is key. You'd have to use the MFI, which is your money flow index, to quickly identify overbought and oversold conditions. An MFI value above 80 indicates overbought condition. Once it's above 80. At this area, you can see in this area it was above 80, it was at 82. At this area, this is an overbought condition, suggesting potential selling opportunities. So at this area, we'll be anticipating selling opportunities to occur. While when the value is below 20, it indicates an oversold condition, suggesting potential buying opportunities. Divergence occur between the MFI and price movements, which are crucial for spotting potential trend reversals within a day. Now, the divergence is when price is going to the upside and at the same time, price is not reflecting that on the MFI. This would indicate a divergence. That's what it means. As you can see at this area in the market, price was moving to the downside here on the MFI, but you can see it was still trending to the upside. This would have been a strong divergence. For day trading, it is essential to focus on intraday divergence, where price and MFI moves in opposite direction within a short time frame. This can signal a rapid change in market sentiment, allowing you to capitalize on short-term trends. So, like I said, this is a particular divergence when market is trending to the upside, but at the same time, it's showing you that the market is trending to the downside at this area. As you can see, if you can look at this part in the market, you can see it's trending to the downside here, but you can see, oh my God, judging from this, you can see at this point in market, price is trending to the downside. But if you look at this from here, you can see price is going to the upside at this area. This is a divergence. It means that we're expecting a reversal. Instead of it to continue to the downside at this area, it is going to go to the upside. Now to execute your trade, to execute trades, to execute trades effectively in a day trading approach, you have to wait for the MFI to cross the MA in the direction of your trade. So once the moving average crosses, you would expect to enter your trade. If the MFI crosses below the moving average, that's the price. At this point in price, you can see that the MFI is above is is above 80 at this area, and we are looking for selling opportunities. Once price has crossed below, once the price is below the moving average, it signals our entry to occur. At this point in time, this is where we would want to seek to enter our selling opportunity. Remember the rules. Once the MFI is above 80, it is an overbought condition, so we are anticipating selling opportunities. So to trigger our entry, will be triggered by when price trades below our moving average. When price trades above our moving average and price dips below 20, this indicates buying opportunities, and this would be a perfect opportunity for us to enter a long position at this area. So we need the relationship between price and our moving average, and we are respecting the rules of the MFI. This is how we execute our trade. To ensure that you have to enter the trade, you have to ensure that you have a solid risk management strategy in place. You can include tight stop loss orders and appropriate position size based on the volatility of the market. For day trading, it is crucial to always set your stop loss close to your entry to limit potential losses if the trade do not move in your favor. So you always have to monitor your trade closely and adjust as needed. Close your trades when the MFI returns to neutral level. Neutral level is when it returns to at least 50 or between the 20 to the 80 region. Once it returns there, this is an opportunity to watch out to start closing your trade. Or you can wait for when the divergence is confirmed. Once you spot a divergence between price and your MFI, this shows that the market might likely reverse. So you would have to close your trade or you start securing profits along the way. All right, traders, we have come to the end of this video. Engage with us in the comments below. We want to hear about your experiences. So if you found this video helpful, do not forget to like, share, and subscribe. Turn on your notification bell so that you wouldn't miss out on more trading tips and strategies. Thank you for watching, and I will see you in the next video.